All right, good evening, everybody. It is October 11th of 2022, and this is our quarterly economic update for the third quarter of 2022. We're kind of talking about what's happened in the U.S. economy, what the indicators are showing from that perspective, and just kind of our forward-looking view on what is going on in the markets and what is going to happen in the markets. My name is Ryan Herbert, as always. Here we go. Everybody knows our team here. We've lost a few people. We've added a few people since this photo was taken. But everybody knows myself and Adrian and Mike and Catherine and Lawrence and Dawn and our team there. Just Mike and myself. As always, the presentation is for informational purposes. Is not intended to recommend any type of investment, and past performance doesn't guarantee future results. Our normal disclosures from that perspective. If you want to ask a question, there is that question box in your panel, the panel that popped up on the side of your screen. Type your question in there as we go along. I'll try to address them as I see them. I do keep the questions minimized while I'm talking, just so I can kind of see what's happening on my screen, but please ask the questions as I go along. If it's too intensive or too personal, I'll just tell you that, and then we can talk either over the phone or in the office from that perspective. This is not a crystal ball, rather just the factors that Mike and myself and our team consider when we're making the decisions in the portfolio. I mean, obviously there's a lot of volatility happening in the market. Just wanted to take some time out just to kind of talk about what it is that Mike and I are seeing out there in the markets. One of the big things that everyone should be aware of is that the House has passed the Secure Act 2.0. We are waiting on the Senate to actually vote on it at this point. Highly likely that they're going to vote on it by the end of the year and pass it. Some key things about the Secure Act 2.0 is the fact that it's automatically going to enroll new employees. So everybody who signs up for everybody who's employed by a new job and is eligible for the retirement plan, they're automatically going to be signed up, and it's automatically going to increase their pay every single year up to at least 10%, but no more than 15% of that pay. More importantly, the catch-up contributions for employer-sponsored retirement plans. What that is going to do is increase the catch-up up to $10,000 for anybody over age 62 through age 64. And just excuse me 1 second. There we go. Sorry, my doorbell's going off, and I'm just silencing the Ring camera that we're seeing. Also, it's going to allow for Roth 401k matching contributions, because right now, if you put your contributions into your 401k and it's going into the Roth, your employer's contributions are still going into that traditional side. Another key aspect is that they want to change the RMD age. If everybody remembers, when they first passed the first version of the Secure Act, it took that RMD age, so the required minimum distribution. This is the point at which the government says, hey, we've let you put your money in these accounts all these years and avoid paying tax on it. Now we want you to start taking money out and paying tax on it. So the first version of this act pushed it from 70.5 to 72. What this now is saying is that if it's passed, it would be 73 starting in 2023. Then in 2030, it would be 74. And then 2033, it would be 75. Really what they're doing is they're encouraging you to leave the money in these accounts longer, letting the accounts continue to grow as they're invested. Obviously, periods of down markets are kind of contradictory to that, but their incentive is to have you have your money in these plans as long as possible, allow them to continue to grow tax deferred, so that way the RMD amount is bigger when they have to take it out, because your age is higher and your age is higher in their fund life expectancy table, and the amount that you have in the account is bigger, so therefore it's a much bigger RMD amount, much bigger amount that you're going to pay in taxes. Okay, so the Federal Reserve is continuing to raise interest rates, and they are raising interest rates in a much more aggressive manner than they have in the past. So what we have here is the change in that Fed funds rate. That is the rate at which the overnight lending rate banks charge each other. That's what this is showing. So this is showing you the percentage change over that time frame as far as the number of months it took us to get there. So this rapid rate that we have seen right here jumped up very quickly in a matter of months. The last rate hike that we saw way back in 2015 at this point took a very long time for it to really reach its peak. 2004 was still a very long time. The other rate hikes that we saw in 87, 94, 83, and 99 weren't that aggressive. Really what we're seeing is that the Federal Reserve is going to continue to increase this rate until it reaches its finish line of bringing the inflation rate down to about 2%. Based on the most recent projections from them, what they're thinking, the Fed funds rate is going to move up somewhere between 4.5% to 4.75% by early 2023, so some point next year. The risk that we run with them raising interest rates so rapidly, so quickly, is that risk of recession. Even Jerome Powell, the chairman of the Fed, acknowledges that maybe this would cause a mild recession. He calls it mild, but really the possibility of a much more serious issue really is kind of coming to about. The fear is that we're not just going to push the U.S. into recession. It's kind of going to cause a global recession and possibly destabilize some of the financial markets in the process. Volatility has spiked up across all of the markets, from currencies to bonds, really raising concerns about the overall global economy being able to cope with these higher interest rates. That's what I talked about, potentially destabilizing some of those markets. If the trends continue, really, the Fed may end up reducing the rate of its quantitative tightening, which will kind of reduce their overall balance sheet. Overall, the Fed was pretty late to start tightening and allowing this inflation to rise, which is why it got up so quickly. We are now starting to see the impact of them raising the interest rates. We're starting to see the prices on certain items start to come down at this point. Overall, this monetary policy that the Fed is putting in place, this raising of interest rates, it takes time for it really to trickle through. So it really works with quite a bit of a lag. The impact of these rate hikes, as I said, is really just beginning to work its way through the economy. Typically, the time frame is about 18 months before we really start seeing the effects of these rising interest rates. That really kind of puts us to late 2023 at that point. But the impact is starting to show its way through the economy. There's enough evidence out there that the rate hikes are working. Our GDP growth really has slowed to kind of a crawl. Housing prices have started to come back down. Manufacturing prices have started to come down. However, what we're seeing here is the U.S. Conference Board leading economic indicators here, showing us that overall confidence in the U.S. economy has fallen over the last 6 months. That's kind of what we're seeing. We had a peak here. Confidence is starting to come back from that aspect. But there's a good chance that parts of the economy actually already have entered a recession. The rising interest rates, there's no surprise that with these rising interest rates, confidence starts to slip. But really, it is all of this, everything that the Fed is doing is a part of its plan to slow down the demand side of our economy. You learned about supply and demand back in college or in high school when they talked about economics. What they're trying to do is slow down the demand side so much that supplies really start to build up, and therefore will lead to a lessening of prices across the board to trying to get rid of this supply glut that they're trying to create. I was just reading an article prior to this that Morgan Stanley is expecting a large number of sales to happen this holiday time because there's a huge buildup in inventory that started to happen simply because all of the supply chain issues that COVID started have pretty much worked their way out. And if you remember, we talked about this back in, what was that? July or April, I talked about shipping costs are starting to come down, which is kind of indicative of the supply chain issues easing. So what we're seeing is now we're finally starting to see inventories build up, which is kind of the first step in the overall goal of what the Fed is trying to do to help bring down inflation from that aspect. The most recent troubling development that we've seen is that there's been a spike in volatility across all the financial markets. Everybody has seen what's going on in the markets. It's no surprise what has happened in the markets. The US dollar really has surged to an all-time high against a lot of other currencies. It's a combination of relatively high US yields and the US dollar really being seen as a safe haven for assets when we have all this global political turmoil that we're seeing. A strong dollar in the United States really helps hold down inflation by making imports less expensive. Therefore, every dollar that we have can buy more goods. It also slows growth by making U.S. exports more expensive. Really what happens is as the dollar grows, it makes U.S. exports more expensive to our trading partners. So what we're seeing is that our dollar is now becoming more competitive. We are able to have a lot more purchasing power for those imported items into the United States. Volatility, what we're seeing is there's a lot of volatility in the Treasury markets in that aspect. Everybody knows that we have taken the stance to not hold bonds for the last couple of years simply because the Fed has been very, very telegraphic in we are going to raise interest rates. As the Fed raises interest rates, the prices of bonds falls. Bond markets at this point year to date are down between 18 and 22%, depending on the level, the length of time of those. So by using that bond replacement strategy, using those products from North American and Athene and Security Benefit really has lessened the overall blow to the portfolios in that aspect. Really what we're seeing now is that foreign central banks are having to really raise their interest rates to help stabilize their currency against the US dollar, their money against US exports. The US dollar is still the world's reserve currency and is used in the majority of global market transactions. A rapid rise in our dollar really does kind of increase the cost for people to borrow money globally. The stress that we have out there in the Treasury markets, volatility is really starting to spike up here. The last time we saw all that volatility was in the pandemic crash that we saw in March of 2020. What happened then is the Fed stepped in and provided more reserves into the system. So we're starting to see that risk in the Treasury market really start to rise up in that aspect, still indicating that bonds are not the place to be out there in the market, because there still is that risk of losing money in those bonds, individual bonds, more over those bond mutual funds, as the Fed continues to raise their interest rates. Overall, financial stress on the financial systems has really started to rise pretty significantly. Currently, all the measures of global financial stress have risen more sharply. We can see right here, has risen up a lot more globally than it has in the United States. What this is reflecting is market volatility and the increasing cost for institutions or businesses to borrow money in the markets. As the Fed has raised interest rates, as all these other foreign central banks are raising interest rates, they're making money more expensive to borrow. We don't expect the Fed to stop raising interest rates, because they said we're going to continue to do this until we hit our target, which is sometime in 2023. It is a good sign that everything that's going on in these financial markets may force the Fed to slow down its pace, not be so rapid. If you remember that slide I showed you a little bit ago, not be so rapid in the way it's hiking the interest rates. When they start to taper off this raising of interest rates, it really kind of is showing us the groundwork for lower inflation in that aspect. But all this stress that we're seeing in the global financial markets really can help trigger those recessions, a true economic recession from that aspect. I think I that's that one there. Sorry about that. One of the things that we're seeing is unemployment. Unemployment is staying low. That is one of the goals of the Fed, is to keep inflation low. What I'm showing you here is the JOLTS rate. So that's the quit rate. That's the rate at which people are quitting their jobs, and versus the wage growth. So wage growth has been steadily increasing. We've seen this here. Wages are continually getting higher right here through 2022. The rate at which people have quitted are willing to quit their jobs. Obviously, no one wanted to quit their job in 2020. There was fear of losing their job, fear of being able to get a new job. But now really started to tick up. It has fallen back down a little bit. Really what we're seeing is, one of the more telling measures in the economy is that workers who are frequent to switch jobs are looking for that higher wage growth, more so than those who just stay in their job longer. Really what we're seeing is wage growth is now started to stabilize. It's going to lead to not many people quitting their job and moving to new jobs. So overall, really what this is showing us is that unemployment is going to stay at a relatively low level. That's one of the things that the Fed is trying to do. Right here, you can see we had a lot of wage growth running up to 2020. That's because the stock market was doing so well. 2021, it started to fall off. 2020 through 2021, it fell off. Now it has come back up. We had a pretty rapid rise. Now we are stabilizing in our wage growth. The Fed is really focused on stabilizing this wage growth, bringing it down, trying to kind of taper those inflation concerns. The hourly earnings rate has been steadily increasing since the end of the pandemic, increased 5.2% on a year over year. What we're seeing is that some workers who have been out of the workforce for a number of years now are now finally re-entering the workforce because those wages have grown enough to where they decide they want to go back to work versus just sitting at home in that aspect. The more people that go back to work, the more people that are making money, the more people that are spending money, really driving our economy forward in that aspect. Warning signs for recession. A recession is when we have two periods of negative GDP, two consecutive quarters of negative GDP. That is what a technical recession is. But really, all the recessions are called by one of the economic institutions out there. But what we're seeing traditionally, anytime we've ever had a yield curve inversion, what that means is if you go out and you buy a 2-year treasury and it pays more interest than a 10-year treasury, that's a yield curve inversion, meaning that I'm going to get more interest on my money by putting it away for 2 years than I would if I was going to put it away for 10 years. You want it to be so that the longer you put your money away, the more interest that you're going to get. So what we're seeing here is the yield curve is now inverted. The 2-year yield has been consistently higher than the 10-year treasury, going back to right about here, which is about July. Another rate hike by the Fed, because of how rapidly that they're going to do, is going to turn our entire yield curve. So this is just looking at a 2-year versus 10-year. But what this is going to do is make it so that the rates for putting your money away for 3 months is going to earn more than if you bought a 30-year treasury. Anytime we have these yield curve inversions, it really is the early warning signs, or the signs that we are in or about to enter a recession from that aspect. This is a slide that I showed us back in July, and you can see right here, this was the end of June, early July. We were right above it. And I talked about this, that one of the indicators is when we see this dip below. Finally, it happened. Here's that same exact point. You can kind of see our up and down, and then we were right about here. We hit that line, and then we actually dipped below in July. So as the Fed continues to raise rates this rapidly, it's going to cause this yield curve inversion in that aspect. Global purchasing. There's a typo on this. Purchasing Managers Index. This is a timely indicator of global economic activity. We can see it's really been dropping off. So global economic activity has dropped. What this is showing us is that the activity has stalled. The leading measures of this index, which is saying new orders and orders for exports have started to drop, really showing that inventories in that aspect are building up because people are not placing orders for manufacturing. They're not placing orders for exports to refill their supply, to refill their inventory, because things have started to build up. You can see right here, these gray lines, these are the recessions that we saw, 2001, 2002, 08, 09, very brief recession in 2020. But more often than not, when we have these really rapid drops, where we start to dip below 50% right here, typically is when we see a recession. And we are certainly headed that way, dropping almost down to 50%. So the indicators are really showing us that a recession is coming from that aspect. Earnings and recessions, the global manufacturing really shows us that trend for global companies. This chart here really shows us the relationship that we have. So here's our global manufacturing index. That's that one I just showed you. Our PMI index, starting to show that drawdown from that aspect. We are really at a point to which earnings season is coming up, and we are really expecting weak earnings pretty much across the board. Earnings overall, they have been resilient to the economic slowdown that we're seeing, but the increasing evidence that we're seeing less growth in those markets is really telling us that we should expect lower earnings and much lower financial forecasts for that fourth quarter. A lot of this is doom and gloom, that we're facing some headwinds in the market. The good news is that the earnings recession, the individual companies reporting these low earnings, is potentially going to be fairly mild. Really what has happened is these rising interest rates, I'm going to keep saying this, the rising interest rates has caused low demand. Not a lot of people are out there buying items. So this low demand really has allowed the supply conditions to improve. You know, the supply chain stress, because all those issues that were caused by COVID have started to ease. Supplies are starting to build back up. Inventories are starting to build back up. A lot of firms that place these orders for manufacturing, they're now reporting that these long delivery times that we had. If you remember, you know, you would order something in 2020 or 2021, take several months for it to come in. You know, furniture, things of that nature took a very long time to come in. Lumber was very expensive. The prices on lumber have come back down. The delivery times for companies ordering new products is now at its lowest level in almost 2 years. What we're seeing is there's a great potential for excess capacity in that manufacturing sector, meaning that manufacturers have additional processing power, additional manpower to process those orders. What that's showing us is that when our inflation comes back under control, when the Federal Reserve is done raising interest rates, the rebound that could potentially be seen could be very strong because of all of this excess processing power. So right now in the portfolios, you know, kind of across the board, most people are down somewhere between 8 to 12% when I'm meeting with clients, and it really all is because of the protective measures that Mike and I put in place. We made those moves to cash, but most importantly is using those products from North American, from Athene, from Delaware Life, from Security Benefit, really to protect that bond money. Overall, stock markets are down anywhere from 25 to 30%. The tech sectors or the tech markets down much more. Bonds themselves are down 18 to 20% overall. When you're looking at your investment account statements, the important thing to remember is you want to take those the security benefits, those North Americans, those annuities, you want to take those into consideration, because under normal market circumstances, all of the money that we have in those products would otherwise be in bonds, inside of your portfolios, inside of your stock accounts. But instead, we move them out to have that protection, because we knew as the Fed raises interest rates, the prices of bonds are going to fall. So having those products there, that is really what's given us a lot of the protection in the overall portfolios. You know, you're going to be seeing moves to cash in the overall portfolios. Overall, if you haven't started to notice it already inside of your portfolios, just because of everything that I talked about with these indicators, looking that there's nothing truly out there in the stock market that is going to get better in a very short manner of time. Everything the Federal Reserve is doing, all of the movements that they're making, is going to take time for it to fully show itself before we can see some type of recovery in the overall market. And that is really what I have for you guys tonight, really kind of short and sweet from that aspect. I hope I was able to address any of the questions that you guys have out there. But as always, if you have any additional questions, please feel free to shoot me an email. It is ryan@prostatisfg.com, or give me a call in the office at 410-863-1040. I just want to say thank you to everybody who decided to join us tonight. I hope you found the information useful, and I hope that I was able to explain it in a way that was easily comprehended. Thank you, everybody, and have a good night and a good rest of the week.